Good evening, everyone, and welcome to tonight's webinar. My name is Anthea Hudsenberg, and I head up platform and community here at Catalyze U. While we wait for a few more people to join, I'd love to hear where everyone is dialing in from. Please take a moment to introduce yourself in the chat. Tell us where you're dialing in from and also what you do. Before we jump into tonight's conversation, I have some very exciting news. I'm very excited to announce our brand new fellowship, which is called How to Start Up. This fellowship is a collaboration between Catalyze U and Future Africa. As most of you or some of you will know, Future Africa is a VC fund and also one of the earliest investors in Move, which has been in the news recently after closing their $100 million funding round led by Uber just last week. And so we are very excited to be working with the team at Future Africa. In this program, fellows will have the opportunity to learn directly from some of the most accomplished founders and investors in Africa. These industry giants will be delivering live lectures throughout the program, sharing and drawing on their practical experience of building high-growth companies on the continent. Two of the notable lecturers are E. Nolua, or E. Abuheji, who's the founding partner of Future Africa. He is also the co-founder of two of Africa's first ever billion-dollar startups, Flutterwave and Andela. Under his leadership, Flutterwave became one of the fastest growing payment businesses globally, processing today billions of dollars in transactions. Joining E is Mia von Koschitzky-Kimani, who is the managing partner at Future Africa. Mia has a unique perspective on the African startup ecosystem and understands the challenges and opportunities that startups face because she has been there herself. She co-founded a successful startup that was ultimately acquired by MasterCard. These are just a few of the incredible instructors you'll learn from on the How to Start Up Fellowship. Some of the others are flashing across your screens as I speak. Applications will open next week, but if you are interested to hear more, simply scan the QR code on the screen or click on the link that my colleague Benji has just shared in the chat. On that note, I'm very excited to kick off tonight's conversation. Tonight's webinar marks the beginning of our series where we deep dive into the metrics that matter most to VCs. And we are best placed to host this conversation because of our wide network of VCs from across Africa and also internationally. Whether you're a seasoned founder or just starting your journey, this series is designed to equip you with the insights you need to succeed. The reality is that understanding these metrics can be the difference between securing VC funding for your startup or struggling to gain traction in a very competitive market. Without solid metrics, investors are less likely to understand your startup's potential for returns, which can lead to funding round stalling or your startup receiving a lower valuation. Metrics that demonstrate user growth, customer acquisition costs, and user engagement, amongst others, are crucial for proving your startup's ability to scale. So I'm very excited to kick off the series this evening. On this series, which will run over 4 webinars, we are going to be bridging the gap between the point where your startup needs to raise funding in order to scale or power the next stage of growth and the investment opportunities that lie out there. Each of the webinars will delve into different aspects of VC metrics, including financial, growth metrics, and our last one will focus on sector-specific metrics. How we'll tackle it, we'll explore how these metrics impact investment decisions, and most importantly, we'll discuss practical strategies for interpreting and presenting your data effectively. In today's session, I am very excited to talk about the core metrics VCs prioritize. It is the first in our series. And on that note, let me introduce you to tonight's panel as I stop sharing and bring them onto the screen. So our first speaker joining is Dolapo Morgan, who's a VC investor at Ventures Platform. Our second speaker is Adeshina Adewumi, CEO and co-founder at Trade Lender. And our final speaker is Calvin Rupango, investment associate at Ajim. Welcome to you all. I'm going to ask you to briefly introduce yourself. Let's start with Dolapo.
Sure. Hi, everyone. Can you hear me clearly?
Perfect.
Okay, great. I'm really excited to be here with the Catalyze U team. I'm an investor with Ventures Platform, early stage VC fund, investing in pre-seed to pre-Series A deals across the continent. Prior to this, spent most of my career doing strategy consulting across emerging markets in Africa and the Middle East. And yeah, very excited to talk about these things. I know the market right now isn't great, so these kind of conversations are definitely needed to keep the momentum.
Fantastic. Thanks to have you. Thanks for being with us, Delapo, and really keen to jump into that in a bit. Going to hand it over to Adeshina.
Thank you very much. Great to have you all here. My name is Adeshina. I'm the CEO and founder at Trade Lender. And at Trade Lender, we're actually, the digital bank for MSMEs, helping them to be able to have access to strategic finance to help them fulfill their potentials. Thank you.
Fantastic. And then I'm going to bring on our final speaker, Calvin. Do you mind briefly introducing yourself? And also, there we are. Introducing yourself very briefly, please.
Sure. Hi, everybody. Thank you for inviting me. My name is Calvin Opango. I'm a investment associate at Jim Capital. We invest in presidency stage across Africa. And currently, I'm based there in the UK.
Fantastic. Welcome, everyone. And we're going to jump off into the first question immediately. And this is for Delapo. As a VC investor, you've likely encountered numerous startups pitching their metrics to you. Could you shed some light on what are the core metrics you prioritize when evaluating potential investments? And also talk to us a bit about why they matter.
Sure. I guess we start off strong. I would say there are like 5 core things that we look out for. One is around the growth of the startup. So since inception, how have they grown, whether this is revenue, and how do they grow on a monthly basis? Because for us, we want to invest in predictable revenue startups, right? So where you have a good understanding of what drives your growth, and you just basically need capital to boost that. So we want to see some form of predictability from like your growth margins and growth rates. The second thing is around revenue, and it's not just top line, revenue. It's actually the quality of your revenue. Just because top line revenue isn't always very indicative of that. So we want to look at like your monthly revenue and see how that has moved. We want to look at right now in this climate as well, if there's any currency diversification. So for startups that have the ability to gain FX right now, we're very excited to speak to those startups, just given the current like climate, or whether you have a stabler currency. So like Francophone Africa, we're very keen on that, given the stability and the peg to the euro. We also look at how your revenue looks. So is it a few customers that are driving your revenue, right? If it's maybe, I don't know, 5 customers are driving greater than 50% of your revenue, that might, give us some form of question marks. We want to see that your revenue, there's some form of diversification, right? So that if you lose one customer, it doesn't like significantly kind of bring you down, even though you're an enterprise, you have enterprise businesses as your customers, they still shouldn't be the only source of revenue. So that's the second thing on revenue. The third thing is around the market, and this is so important, especially for funds, right? Because you're investing to be able to return the fund in some capacity. And so every single investment that we're making, at the back of our mind, we're trying to calculate, can this investment return a good chunk of the fund? So we wouldn't say 100% of the fund, because we're in Africa and we understand that there are nuances to the market, but can you return at least a quarter of the fund, meaning you have to exist in a very huge market, and you must have the ability to essentially capture quite a good amount of that market. So in the next 7 years, can this company generate $100 million is a question that we constantly ask ourselves when we're debating startups, and when there's like no path to that even happening. For us, that becomes a bit of a question mark, because we have a $50 million fund to return. So those are the kind of things that we think about. Within the market as well is, how are you distributing yourself within the market? So what does your customer acquisition cost to lifetime ratio look like? And that's so important because it helps us understand the sustainability of your business, right? So if you have a huge customer acquisition cost over time, what does the lifetime value of that customer look like? So for example, let's say the the customer acquisition cost, I don't know, it's like $50. For instance, is the lifetime value of the customer $50, meaning it's like a one-to-one ratio? That's questionable for us, right? So I think a good industry standard is about like 3-to-1. When you're doing 4-to-1 means that you're doing exceptionally well. And 5-to-1 can even mean that you're not spending as much in your customer acquisition, right? Which includes things like marketing, ads, those type of costs go under customer acquisition. The fourth thing is around the team. And dare I say, like, this is probably the most important factor, because with early stage funding, you're investing in people. So you're investing in their passion, their technical depth. Do they have a unique insight about the market that other people don't have? That is a question we constantly ask ourselves. And do they have a track record where maybe the founder might not have a track record? It could be the co-founder, or it could be the leadership team. Are they able to hire people that can really drive this business forward? And is this person a good storyteller, right? So can this person gain further investments? Because, for example, if we're doing a pre-seed deal, the next round will be a seed round, and then the next round becomes like a Series A round, right? So can this person convince the current Series A investors within our network that they should invest? And so storytelling is so critical and can really differentiate two founders. And we've seen a lot of that in the ecosystem. And then the last one is the technology, right? At the end of the day, with VC investing, we're investing in tech-enabled startups. So how strong is your technology? Is it proprietary tech to you, or is it made in-house or externally? And what's the strength of your technical team? So those are the 5 metrics. I'll recap. So it's around growth, it's around revenue, it's around your market, it's around your team, and around your technology.
I love that.
That's what we use in-house to literally just dive into each startup we meet. Yeah.
Yeah, and starting off strong, I think that really captures it pretty well. I want to speak to your own experience. Where do founders usually fall, or you are less strong on these that you've mentioned?
I think it varies. I don't think there's like one key thing. I think with people that are new to the ecosystem, actually the market is a big one, right? So they don't understand the scale of returns that VCs are looking for. So oftentimes we're just like, this is an amazing founder, but like he's just building in a market that cannot return a fund. And unfortunately, we can't invest, but we would keep talking to the founder should they decide to pivot into something else and address a market that's a lot bigger. So that is like, that underpins if you're even a VC backable business, right? If it's not in a big market. I think that is like probably one of the major things, especially deals that come through like our website, right? It's like the market is too small. So for us, we wouldn't even want to even have like spend too much time reviewing that. Yeah.
Gotcha. I want to move over to Adeshina, who's a founder and a CEO, but who has actually also raised successfully. So Adeshina, we've heard from Delapo around some of those core ones, metric, market, even team. Can you maybe talk to us a bit about your own experience using some of these core metrics to attract VC funding? Tell us what's hard about telling that story.
Thank you very much. I think just as highlighted by Dolapo, most people don't understand how the VC kind of look at startup founders when they pitch. So one of those things that we also got wrong at the beginning was actually using vain metrics. You see some founders come up and throw all sort of awards or grants, programs they've attended, thinking that those are actually metrics to show or validate their model. But again, VCs are not really caught up for that. Aside from maybe a few angels, who are moved by FOMO, who are maybe a bit sentimental, towards what you're building and feel like, oh, let's just jump on it based on, how they feel like, the momentum is building. But quite early enough, we were able to understand that, and we started building up, on the core metrics from customer acquisition, lifetime value, just as she has mentioned, and even digging a step further from just the top line revenue to what the net margin is in terms of acceleration of growth, and in terms of even how much revenue positive can we be in that sense. In a time like this, it's even more important because I think just as she has highlighted, they are looking towards people who have a source of income in FX, or perhaps a bit of stability, but again, having a bit of positive revenue in terms of your revenue versus your burn rate is also an indication that you actually on track. So I think those are just some of those metrics to keep it short and allow others to engage so that we can cover more. Thank you.
I want to follow that up. I was sitting in on a webinar yesterday around how female founders can raise. And one of the important things that came out of that is, founders just need to do their research. Look at the VCs that you are wanting to approach, understand the sector that they are playing in, what are the things that's, what's their investment mandate and thesis and all of those sorts of things. So I want to come back to your point around vanity metrics and sort of this almost available information that's out there. Why do you think founders fail at this point? That they, they don't do their research, or they don't know how to tell an impactful story? Because if you put a little bit of time into this and a bit of strategy into the funds that you want to approach, you can probably find a lot of information. You can speak to founders who've accessed capital from the fund. You can go to the website, you can go to events, network, speak to the people that's active there. Why are founders not being diligent in this first step?
All right, so what I've seen across the ecosystem is most founders don't talk to each other. I would say that VCs talk to each other more, especially when you see them hang out during events and programs, take over a cup of or a glass of wine or something. They talk about even their portfolios. They talk about the good ones. They talk about the bad ships, and they share, information quite a lot. But when it comes to the founder side, most people see themselves as competitors. So they hardly go to themselves and engage. And one of the things that has really helped us as a business is the fact that we kind of engage even with those that are playing in similar space with us. So we're able to get insights from them, and we're able to share insights also with them. And also when it comes to identifying VCs, you're able to know who is that VC that is saying we have $1 million or $10 million to disburse. Meanwhile, they actually only have $10,000, to disburse. I'm just throwing it out there because you also find that, that's the case. Some people might even come on the call and tell you, oh, we have a range of 100K to 500K. But in reality, what they actually invest is 50K. In that sense. But founders need to learn to connect with each other, see themselves as collaborators, celebrate the other party who is doing exceedingly well. Because again, at the end of the day, if one party is doing well, it means that there's a tendency that it's going to rub off on you yourself, And let's say, for example, trade lender in the fintech for MSMEs, you have another startup, who perhaps XYZ VC has invested in, and there's another VC who wanted to be part of that deal and missed out. There's a tendency that that VC will come to you and come and engage with you because they feel like, okay, we missed out on this deal. Now we have an opportunity or a shot, with you. But you need to learn, who were those people that engaged those founders? Who were those ones that dropped off? What was the reason for them dropping off? What are the things you can put in place so that you can attract some of those people who have the potential to help you move from A to B? I think those are just some of my points. Thank you.
I think that's very important. We oftentimes see other founders as competition, as you mentioned, whereas the power is in that network, learning from each other, especially to grow the ecosystem. I want to come to Calvin now. Calvin, while I bring you onto the screen, I'd like to understand from you how do you assess the reliability and accuracy of metrics presented by founders during the investment process?
Okay. Yeah. So that's quite interesting. So before I run through that, I think let me just go back and try to put a bit of a thought in terms of what exactly happens in the back end, in terms of what we actually tend to look at and what exactly to assess by the end of the day. So I think Dalopo have actually put across almost like 5 of the key areas that almost every VC look at. So I won't get into detail in terms of that. But what I want to emphasize is like taking, for instance, one angle that we also look into, and then let's just talk about growth and also talk about revenue, right? So one thing that I found to be so much interesting is almost every VC, let's talk about MRR, or let's just talk about revenue just in general. So when every founder is asked, how much are you guys making in terms of revenue, everybody usually like to put up all those big numbers. And by the end of the day, it all boils down for us now. The homework comes in terms of trying to assess the reliability and all those aspects. So let's talk about revenue. We start asking the basic questions like, you are talking about you having, let's say it's a SaaS platform. You guys have been building these, and then right now you're partnered up with 42 clients, and then you guys, in terms of your business model, you guys are making are charging at least about $8 per month. So with if it's $8 per month and roughly times 40 customers that you guys actually have, I think it's around 1.6. So initially, that's supposed to be the money that you guys actually getting in terms of revenue. So now we started to get to understand with each and every company that you guys have enlisted, what are these companies and who is exactly the person that you guys are talking to. And then funny enough, we get to the extent, if we really, really like the deal, we get to the extent where we have to reach out to the point of contact person and ask them, so you guys are using this product and we are curious to understand why using this product. So they give you their feedback, what they understand. So it's 2 ways. So the idea is us to get a validation in terms of the product, in terms of the validation. And also the second thing is also to understand in terms of the finances, why are they paying that so much amount of money? What about the other alternative? What gets them to the extent where they're choosing A product instead of a B product? So that gets to the extent where you actually started to validate in terms of a product market fit. At the same time, also that gives you the huge understanding of the appetite of the product. So if you mean to say that customer is excited about that product, they're likely to refer 2 or 3 other people. So that means to say the acquisition cost for that company is going to be reduced. Why? Just because they are not doing a lot of marketing for their product. And then the other companies are going to do referral, and then that also reduce the rate of retention. So that means to say all these customers are going to come back and keeping on using that product. So the moment that we have that validation, it helps us to say, you know what, I think these guys, they're getting somewhere. It's not just the numbers in the book, but then it's actually the value proposition that they're bringing to the market. So when you actually have that as more like a key indicator as a VC or as an investor, it makes it so much easier for you to run through and say, you know what, I think this is a very good opportunity. Now we are willing to explore in terms of looking at the term sheet. How could we understand each other long term? Is the founder willing to learn? That's something which is very huge as well. So you find out that most founders, first day they tell you, you know what, we are willing to learn. We were looking for partners as VCs, all those aspects. Why? Just but they're desperate for the money. But the moment that you give them the money, they no longer even send monthly updates. You're always up on their neck asking for those things. So what you usually do for us as well, to try to strengthen that relationship so that we'll be able to know what exactly does the founder actually gets to the extent of being able to learn with us, also for us to be able to learn as well. I think we get in a space where we are like, you know what, we don't actually invest right there. So we get in a space of like, I think the max that we can get to invest in a startup, I think it's about 90 days. So in that 90 days, what we're doing is trying to see if this founder is actually the one that will be very, very excited about. We are very willing to work with them. They're very accessible. They communicate. They clearly understood the value that we are adding, that is not just money, but then we are coming through in terms of we are looking at the opportunity and say, you know what, this is a very good impact to the community, and then this is how we see ourselves adding a bit of value to what you guys are building. So essentially, those are two metrics that we try to look at and try to see if you could actually work in conjunction with the founders.
There's something interesting that you mentioned in there, which is essentially, if I play this back to you, founders come to you, they share, their data room and, their core metrics with you. There's a process of validation from the fund to understand. And when it's positive and there's definitely great product market fit, huge potential for the startup, you make an investment decision and you decide to go for it. At that point where you've validated the startup, you're getting the money in, there's healthy projections that's also sane going forward. And then you have this point where founders stop communicating, or they don't send updates, et cetera. Keen to understand, how do you help the founders to actually realize that potential that you have now validated through this investment process, and get them back on track to make sure that they can actually reach those target goals?
Okay, so I think it's a good question. But to be frank with you, from the ones that we've actually invested into, we have come across, I really need to be very frank, we've come across with very few of them actually doing that. But then one of the biggest things that we realize along the process is anybody who is playing around, or anybody who is shying away from telling the story or sending those quarterly updates or all those aspects, I think these are founders that end up realizing that, you know what, we get Ajim Capital on our term sheet, but then I don't think Ajim Capital actually can be very instrumental in terms of what we are building. So I think it goes back into the same basic of trying to understand, which is the first thing. As a founder, figure out the VC funds that you don't only get money, but also besides money, you get a very good structure in terms of what you really want to build in terms of partnerships. So I think fundamentally that's the most important thing. Why? Just because we are building a relationship. So it's two people. So the most important thing is building that fundamental foundation. So for us, I think what we are very instrumental towards is try to keep on reaching out to these founders. So we have WhatsApp groups for all of our founders. We also do have I do have twice or monthly follow-up updates, whether they want anything or whether they do need an introduction of anybody. So by the virtue of that, we are no longer looking at what they are not doing. So we are actually trying to teach them what they were supposed to do. So literally, we want to keep on emphasizing on the issues like, you know what, we are in this together. It's a 50-50 partnership. Your success determined our success. We're just been invested in you. We have faith and hope that, you know what, these guys, they could actually result in making us a 10x return for a VC fund right now. So keeping on emphasizing on the relationship and keeping on trying to align with what exactly our objective and also what we're actually looking for in terms of the founders. I think that's one of the most fundamental things that we do at Ajim Capital. We keep on emphasizing that. We keep on reaching out. We keep on telling them or teaching them, you know what, we expecting your quarterly update. If you're raising your next round, who are some of other investors you guys are speaking to? Have you spoken to these ones? Let us just do the introductions. So these are what some of other investors are saying about you guys are doing. They're interested in these aspects. Do you think you can realign? So there's this workshop we went, there's this another collaboration partnership you can do with this another company. So do you think you can have that introduction? So we try to keep on making it more or less like a realignment for them. Why? Just because we actually, by the end of the day, we actually have the best interest for them at heart. So we keep on pushing for that.
What I also hear you saying, which I think is important for founders and would-be founders on the call, is not just about getting the money, it's also understanding what is the support, what is the guidance, what is the access to the network that you need in order to make that relationship work. Just want to remind everyone, if you have a question for our panel, you can drop it into the chat and I'll work that into the conversation. I brought all the speakers back on because I want to pose this question to all of you. So there's often a fine line between focusing too much on metrics and maintaining the essence of a startup's vision and innovation. So want to hear, specifically starting with Dolapo, how do you strike the balance between quantitative aspects as represented and captured in the metrics and the qualitative aspects of a startup's potential? How do you assess that internally?
How we assess that is we actually look at within those metrics I mentioned, some of them are qualitative. So for example, like the team is like really, really important because like I said, the next milestone really is your next round, which is our own metric of success, right? So the MOIC, which is what we measure internally, is like how much external capital are you able to gain after our investment? And so the team's ability to tell a compelling story, I think remains like one of the top ones. I think the technology is one. It's not really a quantitative metric, is relatively qualitative, right? So reviewing the product, the demo, as well of your product. I think the last thing would just be sentiment, right? So what do people think about your product, right? What's the general sentiment? So if it's a B2C product, what are people saying about your product? How are people reviewing your products? Do people know about your product, right? Because investors also source for deals, right? You don't always get whatever comes to you. You source for deals, and you may source for deals because you're constantly hearing about the deal. Like, sometimes we share tweets within our group chat, like, have you guys spoken to these companies, right? And that's because of the sentiment and reviews, right? Because with human nature, like, the success of a business is me telling my friend about your business, right? And I can't keep quiet about your business. So that's also another one, the customer sentiment, especially for B2C businesses.
Adeshina, I want to hear from you on this sort of sentiment shared, but also the storytelling aspect. How important was it for you to be able to tell that story, not only about, the growth metrics, the revenue, but also the vision and the potential, and how did that resonate with investors?
Thank you very much. First of all, I would like to say that founders must understand that some of these core metrics and also ability to tell the story is not just for the VCs. It also allows you to be able to attract and draw in your customers. Being able to speak to their emotions and make them understand why you are actually in the business that you are into would help you to be able to attract customers, would help you to be able to attract various stakeholders, including even your employees, high quality staffs, who will join you on the vision, even when you're going through turbulent times. That's what will help them stay. Customers would also stay. Even investors, stakeholders would also stay with you. One of the things that I respect Ventures platform for is the fact that even when you see some of their founders derail, when they make mistakes that are supposed to be unpardonable, you see them, they will still stick their neck. And I think this is because perhaps of where you can maybe point, the reason to the fact that the founders have been able to sell the vision to, the stakeholders up there. So as a founder, your first goal is to be able to sell the vision. The truth remains that whether or not you get VC money or not, if you're able to tell the story, you get your business to be stable and you will be able to add value. And the truth is, when your business is stable and your customers are talking, the VCs will hear and they'll come to you. So don't focus too much on VC. If it happens, fine. If the goal obviously is to build venture-backed high growth, fine, pursue it. But you need to be able to find a thin line between trying to just make the VCs feel good versus you building your own company. Because the truth is, the VCs also, some of them don't even know your business as much as you. Maybe 90% of the time, yes, they don't. They have some of the fundamentals in terms of principles that can help you move from A to B, which obviously principles can be applied to any business, but they don't know your business as much as you. They have the principles you can use, but you are the one that will tell that story. You are the one that will focus on your growth, and you are the one that will move your business to the next phase. And when the chips are down, you are the one that will figure it out. So just know about the metrics, know your business well, and know how to tell the story. It will help you holistically. Thank you.
Great answer. With that, I'm going to go to our first question from the audience, and I'm going to pose this to Calvin, and then Delapo, you can add if you have. During pre-seed or seed rounds, a very technical question, who determines the percentage in equity that a VC gets? Calvin.
That's actually an interesting question. So usually goes this way, right? So the first thing that actually, I think the first thing that you need to understand about when you want to get VC money, first understand things like valuation, right? I think valuation, getting to start thinking about valuation will help you understand how much of equity you're giving away. And that helps in terms of determining, so when you're fundraising, usually, I think most of the deals that I've seen in Africa, they're not being done by almost like one VC fund. Let's say somebody's raising, and then it's going to be a different VCs that you're going to approach. So understand the VCs that you're approaching. Are they lead investors or these are co-investors? So for the lead investors, usually, let's say it's a pre-seed round. You guys are raising like 5 million, and then you guys are putting yourself at a valuation. You're raising 500, and then you're putting yourself at a valuation of about 5 million. Let's say, so give or take, if your valuation is like 5 million and you guys are raising 500,000, that means to say you guys in whomever the VCs that come to give you that 500,000, they'll take ownership of equity of around 10%. And then there's also more or less like a predetermined layout. You can research about it, I think, up online, of what exactly is expected to be a chunk of equity that you can give away to VCs at what stage. So usually at early stage, which is pre-seed stage, I think it's around 7. I'm standing to be corrected. I think it's still from 7% to 10%, somewhere there, or even some take up to almost like 12%. But I haven't seen an African deal that passes 12%. I've seen European deals that get there, American deals, Chinese deals, they get there. And then usually from seed round, usually also it bars around the same bracket of around 10% to 15%. And then when you're going to Series A, you really have to give up a little bit of equity. So why is this? Because now you guys, you're no, in terms of the matrices that you've been using at pre-seed and seed stage, they're now different. It's now a different ball game. There's now a lot of people that are a group of advisory that is actually now controlling more of these structures and how you guys are going to evaluate yourself. And then as you keep on going up, I think like for instance, companies that are raising Series A, Series B, B, C, D, they might actually give up like a chunk of equity, like 25%. Why? Just was they are raising like 100 million at probably $1 billion. So they give up 25% so that they lure up a lot of investors for them to actually. So it all goes back into different aspects. So I'm not so sure if I've answered it well. I think Dolo could actually put it out, also try to help so that it makes more sense.
Delapo, anything to add there? So I think what we've heard from Calvin is it depends on the valuation, the stage, and also your fundraising strategy. Delapo, anything to add to that?
No, not really. I just shared a link to the chat by Carter. They publish a lot of data, and it just gives a guidance on like how much dilution is ideal. Obviously, there are nuances to it, especially in this market. But it's a guidance, and I would say just ensure by Series A, at least the founders should have at least 50% minimum, because that would cause issues, right? Because they come in and they want to get a bigger chunk, and if they, we did a study internally where we spoke to all the like Series A African investors, and the benchmark was essentially like you should have at least 50% from the founding team at Series A, just to ensure that you're motivated to kind of keep going, because they're going to come in and take quite a bit. But obviously, ideally, you should try and get more than that. That's more of a minimum standard. And then
Gotcha.
Carta is a good resource for generic data like that. Yeah.
Thanks. We'll also make sure that we share it in the post-event notes. We have one more question from Towit. Towit, I'm going to try and make sense of this question, but if you want to ask it live, you're also welcome to do that. So his question, or their question, is how do you balance the need of providing portfolio data / metrics, which are harder to find and collect, and then versus fundraising or data that LPs need in order to show traction in a portfolio? So how do you balance those two? I think, Towit, that's what I'm getting from your question. Dolapo, any thoughts here?
Do you mind repeating the question? I don't quite grasp what
it's a hard one. How do you balance the need of portfolio data metrics, which is harder to find, versus metrics that show some kind of traction in a portfolio?
Okay. I'm not sure I grasp the
I
question.
can-
I think he's on the
I
call.
can
Maybe
shout
you
it out,
can-
yeah?
Here he is. Why don't you
Yeah.
ask the question live?
So basically, we always collect portfolio data, right? But again, we don't press our founders too hard. But at the same time, well, we need to raise funds as funds. So basically, how do you balance collecting portfolio data and again making a case for your fundraise?
Gotcha. Thanks.
Okay, got it. Okay, so from a VC's perspective, all right. I was wondering why the
Yes.
founder was asking that question. So I think with portfolio data collection, my view is if we've invested in you, to be honest, you should be reporting certain metrics, right? And what we try and do ideally is at the start of an investment, we share the metrics that we're going to be tracking. So internally, you've made it a process that you do on a quarterly basis, right? Obviously, there are going to be some ad hoc requests, but the idea is that once you know that you have ventures platform on your cap table, these are the metrics that we collect on a quarterly basis because we report it to our LPs. At the end of the day, it's money that could have gone elsewhere for our LPs. And so it's our duty to actually report where that money has gone to and the performance of that. And I think if you're raising VC money, it's like reporting. People hire people as like whether it's chief of staff or investor relations to ensure that you're reporting the data. How we try and make it easier is just, like I said, doing it at the start of the investment, and just trying not to ask for too much, right? So when someone is asking for too much data, I try and just see, okay, how best can we even extrapolate that data, maybe from their quarterly reports, to just avoid that back and forth. But I don't think there's that much of a compromise, especially with some of the LPs that we have that are like DFIs, like they're very strict on the reporting that's required, and it's our duty to kind of do that, as to be trustworthy and I guess reliable. Yeah.
Thanks, Dolapo. Thanks so much for the question, Towit, and also for asking it live. We are fast running out of time. If you have any additional questions, pop it into the chat. I want to switch gears a little bit now and talk about how to present these metrics effectively. So I'm going to start with Adeshina. Talk to us about your experience of what investors are looking for and what worked for you in telling that compelling story and getting that investment across the line. And then I'll hand over to Calvin and Dolapo for a VC or investor's perspective. Let's start with you, Adeshina.
Thank you very much. So for us, most of our funds, we kind of do a deep dive to understand what they even are looking for in terms of metrics. Again, for some of our investors, just as Dolapo has mentioned, there are some that are heavily focused, especially the likes of DFIs, and the likes. There's some of them that are faith-driven. We have an investor that basically the first core, apart from other metrics that they look out for, is the fact that, you are on a mission, to impact, several lives. There's some of them that your business obviously must be able to point, aside from the regular core metrics that we have, across the sustainable development goals. I'm sure most founders here should be able to align their business in that regard. So several metrics, several focus for investors, but we try to understand what they are looking for, and we then try to sell the story in that line. So different stories, still one centerpiece, which is the goal of why you started in the first place, and where you're going to. And there's really a format about this thing. Once you structure it, from identifying why you started, something to get them hooked, and then how big the market is, just as Dolapo has emphasized, I think you are on track, because every other thing can be tweaked. Your customer acquisition cost can be tweaked. Your lifetime value can be extended based on certain, injection of various strategy. The team is also very important, just as Jalakwa has emphasized, but not just for the sake of VCs. You would meet a whole lot of people who would start with you and would drop off. So you need to be sure as a founder that your co-founder or your founding team, you guys are ready to go the long haul, not just a short. It's not a short game. Building a startup is not a short game. It's not just 1 year. It's not just 2 years. But not everybody is cut out for it. And I'm sure if we do proper analysis in this room, maybe just 40% of people, are actually cut out to be founders. But everybody wants to be founder because of what they see on the outside. They don't really understand the in-depth side of things,
Yeah.
so they kind of just feel like, oh, I want to be founder, I want to have the title. For me, I would say that learn for some of us who are on this call, perhaps you're doing exceptionally well and you're struggling to raise funds, perhaps go and learn, by helping a founder to actually achieve that vision. I know I'm not here to encourage any, and it's not anywhere to motivate anyone, but perhaps go and help a fellow founder to learn and understand, the basics of the basics, which helps you to now understand how to even engage with investors. There are investors who we have built even in pipeline that we're not even telling them we're fundraising now, because the reality is they won't even give you fund at the stage that you are in. Maybe you are in your seed or you are in something and they do Series B, Series A, but you need to keep that relationship. You need to nurture it. It's not when you then need funds. That's when you are going to them fresh. That's when they are discovering you. But if they've known you over the years, you can have that easy transition. And, there's this saying that people say, oh, they only finance those people that they know. The reality is, as a founder, you need to build your network. You need to be strategic about building your network so that they know you. And for me, I think that is very, very crucial. I'm not going to talk too much so that other people can.
I love how you said that I'm not here to offer advice, but there was a ton of really useful advice in there. I'm also going to invite everyone to connect with Adeshina after this to follow his advice as well. Conscious of time, I'm going to round this off. Last two questions for Calvin and then Dolapo. So can you offer up some practical advice or best practices for founders when they are crafting their narratives, trying to include the story, trying to include compelling metrics that will resonate with the VCs who are in that process, thinking about starting it? What are your practical advice or best practices that you can offer? Very briefly, let's start with Calvin and then we'll end up with Dolapo.
Yeah, sure. So like Adeshina was trying to put across, investors that invest in people that they like. I think that's very, very important in terms of understanding how the money goes, right? So the VC or the investment game is always about building a network and building that relationships. So what I would actually encourage most of the founder is start building those relationships. Figure out the fund or the VC funds that actually aligns with your strategy. and then start building that relationship very early and starting engaging. Do not actually, so there's a saying that most people say, let's say you have $100 and then you have two people, right? Let's say it's your friend that you have been having a friendship with for the past 10 years or so, and then there's a stranger. Both of them, they're asking for money. Both of them, they want $100. Which one would you give your $100 to? So 100% is the person that you've known for 10 years, or rather than the stranger. Why? Just because for a stranger, it's difficult for you to validate what exactly do they need the money for. But for your person that you've built a relationship with, it's always easier. Why? Just because you understand them, you know what exactly, why do they actually need the money. So putting it into context in terms of founders that are going to look to for investment, either be it from VC or be it from angel or be it from anywhere else, you need to start building those relationships and try to nurture them. Try to make them know you as a person. Why? Just because most of the money that goes, of course, there are matrices, of course, there are those things, but trust me, most VC funds or most VC investors, they love to, they'll push you towards the matrices that they want to invest into you. Like, I still remember at Jim Capital, there's another founder that we built relationship for 6 months, then we invested in them after that 6 months. So you see that if that founder had given up from the first no that we have given him, he would have never gotten an investment from us. But due to the consistency of the building of the relationship, we started to know the value proposition, understand it more, learn more. Why? Just because we are also practically humans as well. We don't actually know everything. You might talk to us today about trade lender, then we fail to understand what exactly does you guys are doing. But then with time, it involves, you keep on educating us, you keep on making us to be very interested in what you guys are doing, the potential of what you're doing. That ends up in that making that decision. So that's my
I love
best.
that, because it's essentially build the bridges before you need them, invest in the relationships, and those relationships can pay off further down the line. Delapo, last question goes to you. Practical advice for founders looking to raise, looking to tell that story around the matrix to get successful funding.
Yeah, I really loved Adeshina's point around you're not just building for investors, you're building for your customers and the rest of your stakeholders. So I'll say that is like the foundation of what your business should be doing before even seeking out money. So ensure that what you're building fundamentally, it works, right? To some degree, right? You then look for funding when you realize that there's something that kind of works, right? In this climate, it's super hard to just raise money without any proof of concept or anything, right? So start with something, grow that, understand your business, because your business evolves, right? But it would be great to come to an investor with some understanding, and that doesn't mean things wouldn't change, but then you really deeply understand the needs of your customers and you've engaged them on a deeper level and you share their pain points. I think the second thing I would like to talk about is just like what Calvin said, is like when you pitch to VCs, a lot of the times we've spoken to other founders that day, right? For example, I take all my pitch calls on Thursdays and it can have like 10 calls back to back. And so you need to come with the idea that that person on the other side of the table doesn't understand what you're talking about, right? Obviously, people have domain expertise, but oftentimes I get on calls, I'm like, did I fully understand or do I need to engage again? And it's always nice when the founder already comes, right, and breaks it down into simple words. Of course you're an expert, but the strength of an expert is actually breaking it down to a 5-year-old, right? So being able to tell your business in the simplest format and in a compelling format. And I think just be conscious of time. So if it's a 5-minute pitch at an event, how you sell your business should be so different from a 30-minute call versus a 1-hour call, right? And I think at the event, it's just trying to exchange contacts rather than talk for 20 minutes, right? Because you're talking to so many people at an event. So just being able to context switch and use the most compelling arguments at the start, right? So whether it's like some of the metrics, at the end of the day, we care about metrics. That's the truth, right? So starting strong, right? Like, the idea is great, but we move more by the numbers, right? And so starting with that is always super helpful, especially when you're doing like a cold email or a cold message. I think would be the other tip I'd like to share. But yeah, I think they've covered it quite well.
The things that I'm taking away there is make sure that you are building healthy, sustainable businesses. You understand that there's product market fit. You know who your customers are. You're solving for real problems. That's important. Try and tell a simple story. So get that elevator pitch right. If you have 15 seconds or an hour with someone that you can communicate that, and then make sure that you are able to tell a compelling story, regardless of where you are, whatever the context is. Thank you so much. Delapo mentioned being conscious of time. I'm going to be conscious of time as well. I want to thank all of our speakers tonight for sharing so openly with everyone on the call. Thank you so much for your time for today and also for all the prep. For everyone on the call, keep an eye out for the post-event mailer. We'll make sure that we share the recording with you and also the LinkedIn for all our speakers. And then if you want to hear more about our future events in the series, make sure that you signed up to our newsletter. From my side, massive thank you, Kelvin, Adeshina, Delapo. Thanks for your time and thanks everyone for joining. I'll see you at the next one. Bye, everyone.